operator, and a very good evening, ladies and gentlemen. This is Ashwin Bajaj, Director of Group Investor Relations. Thanks for joining us today to discuss our results for the third quarter of FY18. We will be referring to the presentation that is available on our website. From our management team, we have with us our CEO, Kuldeep Kaura, and our CFO, Arun Kumar. We also have several of our business leaders with us. We have Sudhir Mathur from Oil and Gas, Amitabh Gupta from Hindustan Zinc, Deshni Naidu from Zinc International, Samir Kairi and Abhijit Pati from Aluminium and Power, and Kishore Kumar from Iron Ore. So with that, let me hand it over to Mr. Kaura.
Thank you, Ashwin. Good evening, ladies and gentlemen. I am pleased to welcome you to Vedanta Limited's third quarter earnings conference call. We have seen further improvement in the commodity prices in the last quarter, and that strength has continued into the new year as well. With the sentiment around global growth remaining strong and China's supply side reforms underway, the base is set for a strong 2018. With that, let me take you through some of our third quarter performance. Numbers first, focusing on safety. Vedanta remains focused on a zero harm, zero waste and zero discharge culture, but regrettably, fatal accidents at 4 of our businesses overshadowed our HSE efforts in quarter 3. 3 of them were fatalities of our contract employees and relate to understanding hazards in the workplace and the effectiveness of supervision. The 4th relates to understanding and control of a critical risk in our mining operations to ensure the stability of waste dumps. Our executive committee has increased involvement in some key areas of visible leadership, risk identification and control, and closure and corrective actions. We have bolstered our HSE organization by induction of additional HSE experts with global experiences. We have also completed a third-party audit for tailing, cash management practices and water risk assessment to identify physical, social and economic risk across the group in India. We have put in place measures to address this and remain committed to bring Vedanta to the best HSE performance in the resource sector. Let me assure you that all of us in our executive team are committed to our safety goals. Slide on results highlights. Moving to our results highlights for the quarter. On operations, we have delivered strong volumes in the quarter and continue with production ramp up across our portfolio. As Zinc India, we had higher production and we remain on track to achieve our 1.2 million ton target. At Zinc International, we had strong production from BMM and Scorpion. Our Hamsburg project is on track to commence production in mid-calendar year 18. At Aluminium, we are continuing to ramp up and have exited quarter 3 at a run rate of 1.8 million tons per annum. At TSPL, we had record plant availability of 97%. At Iron Ore, we have an additional 3 million ton of capacity allocated to us in Goa for the current financial year. The Supreme Court has also increased the mining cap for Karnataka. The company-wide allocation is in progress. We are also progressing well on our growth projects announced last quarter. Contracts have been awarded on the new projects in the oil and gas segment, and mobilization of drilling rigs are in progress. On the 400,000 ton smelter expansion at Copper India, the EPC contract has been awarded and civil works are underway. Talking about the financial highlights, I am happy to report that quarter 3 EBITDA was 6,776 crores and profit after tax was rupees 2,173 crores. We have maintained a robust EBITDA margin of 35% quarter-on-quarter. We have had strong cash flows of rupees 4,600 crore and have reduced our gross debt by rupees 11,450 crore in the first 9 months of FY18. We also have one of the strongest balance sheets in the sector with net debt to EBITDA at 0.7, one of the lowest across both our Indian and global peers. Next slide, please. As we see our assets ramping up and delivering growth, we are also focused on delivering strong shareholder returns. We aim to do this by focusing on our 4 key areas. Executing our strategy, which has been consistent over the last several years and has delivered results. Over 80% of Vedanta's EBITDA comes from commodities that are expected to grow the most over the coming years. We are ramping up our existing capacities and have taken specific action to grow our volumes across all our businesses. India has very strong growth potential and its consumption of key commodities will increase exponentially. We are uniquely positioned to serve this demand, being the only diversified natural resources company in India. We are focused on value creation for our shareholders through prudent capital allocation, and we have a robust dividend policy in place, which entails a minimum 30% dividend payout. Strategic framework. Our strategic framework is quite simple, and I'm quite excited about the growth opportunities in our various businesses and being able to leverage our presence and position with our fast-growing Indian market. Our world-class mines have long life, and we have been continuously adding to reserves through exploration. Through this rich asset base, we will grow across our portfolio both in the near and medium term. Key among that growth will be our plans in zinc and oil and gas. We are actively working on plans to expand our zinc business to 2 million tons of mined zinc and lead, accompanied by over 32 million ounces of silver, and our oil and gas business from a level of 300,000 barrels to 500,000 barrels per day of output. The growth which I have detailed will be funded by internal cash accruals. Our disciplined approach to capital allocation will deliver superior long-term returns to shareholders. I'll walk you through details in the following 2 slides. Near-term priorities. Next slide, please. The priority in the near term up to financial year 2020 is to ramp up to design capacity across all our businesses. Key aspects and projects that underpin this growth are laid out on this slide. We are on track to achieve our volume growth as per our guidance. You have already witnessed the progress of our ramp-ups at Zinc India and Aluminium in Q3. This will accelerate as scheduled to ramp up to respective design capacities. At Zinc India, there will also be significant reduction in the COP as we complete our expansions and transition to the underground mining. At Zinc International, our Hansburg project in South Africa is in erection phase, and the project is on target for first production by mid-2018. In our oil and gas business, development partners have been finalized for our next phase of growth to get to a near-term capacity of around 300,000 barrels per day. At Copper India, the EPC contract has been awarded to double smelter capacity from 400,000 tons to 800,000 tons per annum. In our iron ore business, the state has already increased the mining cap in Karnataka, and we are soon expecting an increase in the mining limits at Goa too, which will enable us to swiftly ramp up to our pre-ban levels of over 20 million tons per annum without any significant investments. Next slide, please. In the medium term, beyond 2020, we have carefully evaluated and conceptualized the following attractive growth options, most of which are brownfield, across our existing portfolio. Some of these include expansion at Zinc India to 1.5 million tons of mined zinc lead, accompanied by over 32 million ounces of silver, given the long mine life of over 25 years. Phase 2 and 3 of our Hemsberg Zinc project, which has the potential to take total zinc concentrate production from 250,000 tons to 600,000 tons per annum. Potential at our oil and gas to increase output from 300,000 barrels to 500,000 barrels on the back of continued exploration and ASP technology. We are also in the final stages of evaluating the alumina refinery expansion at Lanjigarh to 6 million tons. Coming to development of iron ore deposits at Jharkhand, we believe that steel is a natural bolt-on for us to our core iron ore business, as the Jharkhand iron ore mining license, for example, comes with the requirement of value addition. This has been our trigger to evaluating steel assets being auctioned under the IBC. We will participate in suitable opportunities that we believe will help strengthen our iron ore business, provided the investment clears our capital allocation criteria and hurdle rates. I would like to emphasize that as we ramp up to our near and medium-term capacity, our assets will generate strong incremental cash flows to enable funding of all our growth through internal accruals. As an organization, we are well equipped to take up these growth projects with the requisite management bandwidth, global talent base, and systems in place. I'll now hand over to Arun, who will take you through the financials.
Thanks, Mr. Kora. Good evening, all. So we've delivered another steady quarter and a strong set of numbers. It's driven both by higher volumes, reflecting the operating performance per plan, and helped along by a higher price scenario. Thus, the EBITDA of 6,780 crores represents a 17% growth sequentially and a 13% higher year-on-year, despite a couple of inflationary cost headwinds. EBITDA margins continue to be robust at 35%, which is now the sixth continuous quarter of the 35 to 40% range. Balance sheet remains strong, with cash and liquid investments of nearly 39,000 crores. This is post-repayment of a gross debt by about 11,500 crores in the last 9 months. Of course, it excludes the 7,900 repaid by Zinc, which was a temporary borrowing. Our gearing continues to remain best in class in corporate India, whichever sector you take, with net debt to EBITDA at 0.7x. We also had a CRISIL upgrade to our outlook to positive in October, as you recall. While EBITDA or attributable EBITDA per share improved significantly, the mark-to-market accounting on investments and the typical deferred tax accounting have led to an EPS at 5.86 per share, which is higher sequentially from 5.49, though lower on a year-to-year basis. Overall, as you heard from Mr. Kora, A, we are on track executing our current near-term volume and ramp-up plan. B, growth projects, while simultaneously charting out the path for the medium term, where Zinc 2 million tons, oil 300 to 500, eye on alumina refinery at the final stages, as well as iron ore Jharkhand. C, the earnings are good, the cash is good, so it will self-fund all these brownfield growth plans. And we expect that these will be well executed through a credible track record. Those are the three highlights, I would say, of our performance so far. Moving on to the EBITDA bridge on the next page. As we said, it represents a 17% growth quarter on quarter. If you see our aluminum ramp up on track, a run rate of 1.8 should exit with 2 million tons per annum. Zinc grew 7% on metal basis, 10% metal in concentrate and sequentially, so that's a strong growth. Iron ore again post-monsoon, dispatched higher grade ore, better realizations as part of its new production and sales strategy. oil volumes were up too sequentially, and zinc volume, Zinc International, were the highest in the last 8 quarters. Summing up, it was an outstanding quarter operationally, and it helped deliver about 400 plus crores of contribution to the EBITDA out of the total of 1,000 crores increase. The balance, of course, came from price, as I mentioned earlier. We are lucky to have zinc at a 10-year high, Brent and aluminum at 3-4-year highs. Yes, some of the input inflation took away the part of the price upside. Overall resilience, I would say, of the diversified portfolio has been a cornerstone of our investment case or investment thesis, as you would like to call it. And it's played out very well in the last 3-4 years, both in the down cycle as well as the up cycle, as is very evident. And it's probably only one of the 2 companies globally in the sector out of the top 25 to have a very good portfolio of diversified metals and oil and gas, and even in diversified metals, the accent on base metals like zinc and aluminum and copper, all of them in a sweet spot at this point of time, both from our own internal volumes and operations as well as from an external environment. Volume guidance for the year is unchanged, which means we expect the good volume performance to continue into Q4, and perhaps beyond that, given the fact that the next year will reap the benefits of a ramped up asset base. We also expect the cost inflation to ease soon, especially domestic coal. Government is doing some good work to bring it down, bring the supplies up and costs down. Alumina is already easing from the peak levels that were seen in Q3. So with that hint of optimism, I'll move on to the income statement on the next page. Self-explanatory as usual. Some of the headline numbers I've already explained. The other key numbers on the page are on the finance cost. Our blended cost of borrowing was 7.7% for the quarter, continued to stay below 8% for the second quarter in a row. After nearly 8 quarters, we achieved the target, and we expect this kind of rate to stay for the rest of the year and in the near term. The other income line, of course, represents the investment income. It was lower, very clearly mark-to-market accounting, which is nothing to do with cash economic reality, as we continue to hold our investments mostly to maturity. And that's, of course, due to the 65 bips rise in the GSEC yields over the quarter, sharp rise. Investment income for Q4, however, is expected more like the Q2 levels, assuming the GSEC would stay stable during the quarter. I'm sure that helps you model out some of the cash flows. The portfolio, of course, is outstanding, continues to be safely and conservatively invested, Tier 1 assets, very good based on CRISIL audit and rating on a monthly basis. Depreciation line, FY18 would be marginally lower compared to FY17, nothing new in the guidance out there. Tax line, again, well within our yearly guidance of, we had always said mid-20s to 30%, we'll probably come up at the higher end of the range. For the quarter, it's a tad higher. That's again purely deferred tax accounting and some true-ups, but for the year, we should be in that range. With that, I move on to the next page. Net debt waterfall during the quarter. As you can see, we generated a cash flow from operations of over 5,000 crores, clearly driven by a higher EBITDA and fundamental operation performance. That helped us in reduction of the net debt to 14,500 crore prior to acquisition, of course, despite a 2,100 crore spent on capex in line again with our guidance. We continue to be disciplined in our capital allocation, with all our capex spends having IRRs of 20% and above. We are likely to be marginally lower than our 1.1 billion capex guidance for the year, basically a timing of a plus minus few weeks here and there. Our zinc business capex program making a steady progress. We've commenced the next phase of growth program with the copper smelter project at Tuticorin, as Mr. Kora highlighted. And oil and gas, again on track of all the projects that we announced, during the Capital Market Day in London during the month of November. Working capital investment you see on this page is mostly driven by LME prices, few one-off items. All of it should reverse back in the coming quarter. So we feel good about the upcoming fourth quarter as usual, which last few years has always been a strong quarter as we wind up the year in terms of cash flow. One-off investment, 158 million, about 1,000 crores in Japanese manufacturer LCD glass, which you all know. Obviously on consolidation of books, given the transactions consummated, there will be the net debt which will add on to the balance sheet. Otherwise, the net gearing at these levels, as I reiterated earlier, 16%, really the question is what is the right level out there. Moving on to the final page, the priorities remain consistent. Again, if I have to summarize, the focus on cash, capital allocation, and volume growth will deliver the consistent earnings into the near future. It will keep the balance sheet strong and self-fund all the growth projects. I think Mr. Kora also made the point. And as I mentioned earlier, the diversified portfolio, especially base metals, and zinc is a highlight of the base metal space, whether it's the price side or the cost side, with a handsome margin of $1,800, $2,000 plus margin per ton at these levels. And oil, of course, are an important part of our growth strategy, and we are blessed to be in these two spaces as we look forward. And we continue to be a compelling investment proposition for both equity and debt investors. And with that, thank you all for the patient hearing, and back to Mr. Kora.
Thanks, Arun. Zinc India slide, please. Yeah. Starting with Zinc India, we have achieved mine metal production of 240,000 ton, refined zinc lead production of 245,000 ton, and refined silver production of 132,000 tons in the quarter 3. Our COP was higher due to high input commodity prices such as met coke and imported coal, and also lower overall grades in quarter 3. We are in the last year of the transition, and I am happy to report that the underground mines have ramped up to contribute 85% of total production in the last 9 months. Rampura Agucha underground mine crossed a 2 million ton run rate of ore production last quarter. The rate will significantly accelerate in quarter 4. SK Mine has crossed the 4.5 million ton ore production run rate in quarter 3, which is 75% of its planned capacity. We are progressing well to achieve our FY20 guidance of 1.2 million tons, and significant milestones that have been achieved in this journey are as follows. At Rampura Agucha, off-shaft development is on track to take total production capacity to 4.5 million ton in quarter 3/19. At SK Mine, equipping of main shaft is progressing as per schedule and expected to complete in quarter 4 FY18. Shaft will take total production capacity to 6 million ton progressively by quarter 3 FY19. Also, public hearing for EC enhancement from 4.5 to 6 million ton was successfully concluded, paving the way for next phase of expansion. The new mill of 1.5 million ton is expected to commission in quarter 2 FY19 and will take the total milling capacity at SK to 5.8 million tons, matching with our core production ramp up. Post-completion of the Zawar debottlenecking to 2.7 million tons, site construction work has commenced for the new mill of 2 million ton capacity, which is expected to commission by quarter 3 FY19. We are happy to report the receipt of approval of Expert Appraisal Committee of MOEF to expand ore production at our Rajput Dariba and Kair mines. On the outlook, we are confident of meeting our earlier guidance of mine metal production to be higher than FY17 refined zinc lead metal production of around 950,000 tons and silver production of over 500,000 tons. Silver production of over 500 tons, beg your pardon. Q4 mine production to be higher than Q3 due to higher production from Rampur-Ugucha mine and higher overall grades. We expect FY18 cost of production to be in the range of $950 to $975 per ton, with the Q4 cost less than Q3, as will benefit from higher volumes and cost efficiencies like usage of linkage coal, etc. Zinc International slide. Moving to Zinc International, we had a strong quarter with a total production of 47,000 tons, mainly due to higher blended grades and operating efficiencies. Cost of production was $1,383 per ton, lower than last quarter. At Scorpion, the pit extension is progressing well with full ramp-up of contractor mining. 25% of waste stripping has been completed and full completion is expected by Q4-19. We have also extracted the first ore in November 2017, slightly ahead of schedule. This project will extend the mine life to 2.5 years and produce 250,000 tons of metal. Our production guidance for FY18 remains unchanged at 160,000 tons. Although the 9-month cost of production has been around $1,500 in line with our full year guidance, Q4 cost of production will temporarily be higher at $1,700 due to reallocation of stripping costs of pit 112. At Hemsburg project, we have Deshni Naidu, our CEO at Zinc International, on the call. Maybe I'll ask her to expand on the Hemsburg project progress.
Sure. Thank you, Mr. Kora. Well, on the Hemsburg project, we remain on track with our guidance of first ore production in the middle of this calendar year. In Q3, we had record excavation of about 70% of the waste rock of our total pre-stripping requirement of 60 million tons. We are on target for 500,000 tons of ore stockpile ahead of the first feed date. Construction of the concentrator is underway, and we remain at peak contractor strength of around 2,500 people on site. In terms of selected highlights for the quarter, the ball mill shell and crusher mechanical erection has been completed, and the power and water pipeline infrastructure is over 90% complete. We are expecting cold commissioning of the concentrator plant to start early this quarter, which is already underway. Thank you.
Yeah, so thank you, Deshni. Now we move to oil and gas, and I'll request Sudhir Mathur.
Thank you, Mr. Kora, and good day to you all. In the oil and gas business, we have commenced our journey towards our vision to contribute to 50% of India's crude oil production. In this journey, there are three key elements.
Excuse me, Sudhir, we cannot hear you very well.
Increase the volume if I can. Hello? Ashwin, can you hear us?
Yes, sir.
Yes, better now, please. Thank you.
Please go ahead.
Thank you. I'll just start from the beginning. In the oil and gas business, we have commenced our journey towards our vision to contribute to 50% of India's crude oil production. In this journey, there are three key elements. Firstly, we have commenced work on the immediate opportunities to increase volumes through infill wells and debottlenecking facilities, which have the potential to add around 20 to 30,000 barrels per day. Secondly, for the growth projects which we announced in Q2, we have awarded contracts to key global oil field service providers. Thirdly, we are regenerating our exploration portfolios through investment in the prolific Barmer and KG offshore basin and participation in the OLAP rounds. Let me begin with our Q3 operational performance. Our core fields continue to deliver along expected lines with gross production at 184,000 barrels. Our world-class operational capabilities have kept operating costs at the lower end amongst our global peers. Rajasthan waterflood OPEX was at $4.3 per barrel. Blended operating cost for Rajasthan was at $6.4 per barrel. In Q4 FY18, we are targeting an exit with gross production volumes of 200,000 barrels per day. This ramp-up of volume shall primarily be driven by infill and debottlenecking activities. Drilling of 15 infill wells at the Perfect Mangla field is progressing as per plan, with 8 wells online. The balance wells shall be drilled during the current quarter. In order to boost volumes from our satellite fields, we have commenced 8 wells drilling campaign. Rageshwari Deep Gas Phase 1 ramp-up to 45 SCFD got completed during Q3 as per plan. We are upgrading our infrastructure at the Mangla processing terminal to increase liquid handling capacity by around 30%. We have also commenced a 3-well infill program at Cambay to monetize around 7 million barrels of reserves. The next slide, which is about investments for growth. We have a rich set of options in our portfolio ranging from enhanced oil recovery, tight oil, tight gas, and exploration prospects. As in the past, our development projects generate an IRR in excess of 20% at Brent of around $40 per barrel and provide free cash flow capex every year. In order to execute these projects, we have awarded integrated contracts to global oil field service companies with an inbuilt risk and reward mechanism. Engagement with global oil field service providers also bring the benefit of technology and commerciality. Moving on to individual projects. In our core MBA field, we are focused on increasing recovery. The success of the Mangla Polymer EOR is being replicated in the Bhagyam and Aishwarya fields. An integrated contract for this project has been awarded with rig mobilization expected in the current quarter. In addition, we are also working on the ASP project to boost the recoveries further. This project aims to monetize over 100 million barrels of oil. This contract is expected to be awarded in the current quarter. Monetization of the tight oil and tight gas prospects shall enable unlocking of the vast potential of the Barmer Basin. Rageshwari Tight Gas Project provides us with an opportunity to grow our gas business to a sizable scale. The project is expected to increase the overall Rajasthan gas production to over 150 million scf per day and condensate production to around 5,000 barrels of oil equivalent per day. In tight oil, we are on track to monetize Aishwarya Barmer Hill. The project provides an estimated ultimate recovery of 32 million barrels. The integrated contract for tight oil and tight gas wells has been awarded with rig mobilization expected in the current quarter. Exploration holds the key to ensuring sustainable growth through addition to prospective and contingent resources. The Rajasthan block provides us with a unique proposition of singular access to the full Barmer Basin with its multiple plays. Our partnership with global partners has enabled us to identify exploration drilling prospects. We will shortly award the contract for an integrated exploration and appraisal drilling program in Rajasthan. In the KG offshore, the contract is in place for a 2-well exploration campaign from the current quarter. The target of this program is to add another 300 million barrels of contingent resources. With that, over to you, Mr. Kaura.
Okay. So thank you, Sudhir. We move to aluminium. Aluminium has been a strong ramp-up story this quarter. We achieved record quarterly production of 445,000 tons during this quarter with a current run rate of 1.8 million tons per annum. We maintain our production guidance of 1.5 to 1.6 million tons of aluminium, excluding trial production in FY18. We are on track to exit FY18 at a run rate of 2 million tons per annum. At the Lanjigarh alumina facility, debottlenecking initiatives were undertaken in Q3 to achieve design capacity. However, alumina production this quarter totaled 287,000 tons due to constraints in rail logistics. With the ramp-up of refinery and expected improvement in the logistics for bauxite, we aim to achieve a stronger Q4 and full-year alumina production of 1.2 to 1.3 million tons. Moving on, the cost environment for the aluminum industry has been a point of concern. We recorded cost of production of $1,945 per ton Q3. High input commodity inflation resulted in $160 per ton quarter-on-quarter increase in COP, partially countered by the offsetting impact of revival costs and power imports costs due to operational improvements. Coal cost was higher because of lower realization from linkage coal, higher cost of e-auction and GCV slippage. Other input commodities like caustic and CP coke were also up 35% and 15% respectively compared to Q2. Domestic coal situation is a key focus area for the management. We have secured an additional 2 million tons of coal linkage from the Tranche 3 auction, where delivery should start in February. On 8th January 2018, Coal India announced an increase in coal price across a number of grades, averaging 7 paisa per GCV. We also expect third-party quality controls to eliminate GCV losses, which along with improved linkages will help to marginally reduce the coal costs. We revised the cost guidance and expect Q4 cost of production to be in the range of $1,850 to $1,900 per ton as a result of one-offs elimination and anticipated better domestic coal situation. Power. Moving to power and our IPPs, our 1.9 gigawatt TSPL plant is running at record availability of 97%. We had another record quarterly EBITDA at TSPL of INR 429 crores and maintain our target availability of 75% for the full year. Balco IPP's PLF at 43% recovered quarter-on-quarter, but remained low, impacted by the high coal cost environment. Jharsuguda IPP continued to be adversely affected due to the closure impact related to the hashtag incident and the temporary coal shortage. This is expected to recover in Q4FY18. Moving to iron ore. We had sales of 1.8 million tons and production of 0.9 million tons. Production and sale volumes were lower year-on-year on account of extended monsoons and the low pricing environment. In Goa, we have commenced production of high-quality ore in Q3 through beneficiation and blending, which is resulting in improved realizations and margins. We sold some of this high-quality ore in Q3. At Karnataka, we achieved production of our annual allocation of 2.3 million tons. We continue to have strong realizations of $28 per ton in Q3 at Karnataka. We are working towards improving these realizations in the domestic market. We continue to engage with the respective state governments for increased mining allocations in both states. In January, we were granted an additional allocation of 3 million tons in Goa for financial year 18. We expect to produce saleable high-quality ore of about 2 million tons in Q4FY18. At Karnataka, the Supreme Court has increased the state's cap from 30 to 35 million tons. Company-wise allocation is in progress. Moving to Copper India, we produced 101,000 tons of cathodes in Q3. Production was marginally lower than the previous quarter due to an unplanned plant shutdown of about 8 days on account of a boiler leakage. The smelter is now operating at high efficiency and we maintain our guidance of 400,000 tons of cathode production during fiscal 2018. TCRCs have been marginally lower than the previous quarter as US 28 cents per pound. This decrease was on account of lower spot TCRCs. About 90% of our concentrate requirement are sourced through long-term agreements. Benchmark TCRC for calendar year 18 are about 10% lower than calendar year 17 at 21.6 cents per pound. Our net cost of conversion was higher quarter on quarter, mainly on account of higher coal and input commodity prices and lower volumes. Our 400,000 ton expansion project is progressing well. The EPC contract has been awarded and site mobilization and civil work has commenced. Contracts for the balance construction activities will be awarded by March 2018. The project is expected to be completed by Q3 FY 2020. Completion of this project will place Tuticorin smelter as one of the world's largest single location copper smelting complexes. So that covers update on all our businesses. Coming to summary. So let me once again reiterate our key messages here by saying that Vedanta has a well-invested asset base that will deliver growth, and we are committed to shareholder returns. With our consistent strategy, prudent capital allocation, and growing Indian market, we are poised to grow and deliver on these priorities. With that, let me summarize by stating that our ramp-ups across all businesses are progressing well, which will lead to higher volumes in Q4. We should especially see a good quarter at our Zinc India business as Rampura Agucha increases its production in overall production and with improved grades. Aluminium businesses as we continue to ramp up. At oil and gas from our debottlenecking initiatives. At our iron ore business with better realization as we sell higher quality ore. Secondly, commodity markets remain robust and we have a strong outlook for the future. Our costs are being impacted by high input commodity prices, especially in aluminium, but we are working relentlessly to mitigate these in line with our low-cost philosophy. These factors combined should help us deliver stronger performance in the last quarter and finish the year with excellent cash flows and shareholder returns. Going forward into FY19, EBITDA and cash flows will continue to pick up further as our capacities ramp up and we deliver our near-term growth with Zinc India racing towards 1.2 million tons production and at our oil and gas business moving to 300,000 barrels per day production. Our robust balance sheet will support us this expansion. We have one of the strongest balance sheets in the sector globally, and this will be maintained as our growth will be funded from internal cash flows. With that, I would like to thank everyone and pass you on to Ashwin.
Yes, thank you, Mr. Bora. So, operator, we're ready to take questions now.
Sure. Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sumangal Nevatia from Macquarie. Please go ahead.
Yeah, thanks for the chance. A couple of questions. First, I'll start with more of a top-level questions. First one on the capital allocation strategy. Now, in the last few months, we've learned about investments in LCD, glass substrate company, a non-core area, and also about our interest in steel assets, which you did explain in your opening remarks. So the question is, what's the broad capital allocation strategy we are looking at, and what further investments in these areas, say in LCD, etc., do we expect in coming years?
Service. Yeah, so I think as regards our Startech glass, this was a very small and unique technology-oriented opportunity, supplying materials to a fast-growing market. So this was a small one of investment and should be viewed as such. As regards our capital allocation strategy, as we stated earlier, that we maintain basically we are on 3 pillars. We maintain a strong balance sheet. We look for invest in projects which meet our hurdle rates at a strong IRR, and fundamentally.
Yeah, just to supplement what Mr. Koraji is explaining, I think we've been sharing consistently over the last year our capital allocation very clear, maintain a strong balance sheet, allocate capital to the high return projects. Most of them perhaps will be self-funded. The second point is ensuring that the gross debt comes down. While we have a lot of cash, net debt is not an issue for us, and maintain a high credit rating. And last but not the least is to ensure that the dividends to the shareholders and shareholder return is robust. So it's always going to be a sense of balance between the three. That's really the essence of capital allocation exercise. And we have enough of cash and capital. It's a positive problem for us to have, in a manner of speaking.
Just continuing on this, when we're looking at steel assets having significant debt, so what level of gearing are we comfortable when we're looking at these assets?
I think if you, on the steel asset per se, I will leave it to Koraji, but on the balance sheet side, our gearing is 16% at this point of time. And net debt to EBITDA is virtually non-existent at a Vedanta Limited consolidated basis. So I really don't think it's much of a discussion point on what it is. It's a best-in-class balance sheet, as I've always articulated. Whether you compare it to peers in probably the petroleum sector or the automobile or telecom, any sector for that matter, irrespective of mines and metals. As regards steel, I leave it to Koraji.
Fundamentally, we are in the resources business, and iron ore is our main business. And for the growth of iron ore business, as you are aware, the governments put sometimes stipulation regarding value addition in the grant of the mining licenses. So we look at our extension into steel in that light, and that is the reason we are evaluating some of these assets now. You are also perhaps aware we have 800,000 tons of pig iron capacity at our Sesa complex. So this is how this is our perspective really on the steel.
Understood. Second question is with respect to the oil and gas division. Now, slide 10 near-term expectation says that we are targeting almost a 50% increase, 275 to 300 KPO EPD per day. So, how will volume growth shape up in FY19 and 20?
So, Sudhir, would you like to respond to this? Sudhir, okay.
As we mentioned in the call, as well as in our Capital Markets Day, we've got a line of projects, which we are working on, and I mentioned that the contracts have been awarded for most of them, barring one, which we will do within the current quarter, and the drilling is going to start within the current quarter. So the projects include, starting from the beginning, they mentioned that we are debottlenecking the Mangla processing terminal to increase capacity by 30%. The fluid handling capacity, what it would do is to be able to bring all our wells online. Second, there is an infill program at Mangla that's taking place, 15 wells. We expect this to add to 20 to 30,000 barrels. Our key projects are, Aishwarya Barmer Hill, and the tight gas project, which the drilling is going to start within the quarter. Bhagyam and Aishwarya, ASP, polymer and the ASP project. So all this, all in all, we expect to add more than 100,000 barrels of production equivalent per day, as well as 100 million barrels of reserves. So this will be phased out as the project, depending on how much drilling for which we have a schedule, that will play out.
Yeah, I think just supplementing Sudhir, as you said in the beginning, in India we produce only about 15% of our total crude oil requirement, and out of that we produce about 27% of that today. Our aim is really to take this to 50% level of crude oil production in India. And apart from the projects which Sudhir mentioned, we're also investing in exploration at Rajasthan as well as the offshore areas. And we are looking at a possibility that we can actually take up our oil production to a level of about 500,000 barrels per day going forward in the medium term.
Understand. If I may just ask one more question.
Vedanta, may I request you to join the question queue for any
follow-ups? Thanks and all the best. Yeah.
All right, thank you. Also, participants are requested to limit your question to 2 per participants. If time permits, you may join the question queue for any follow-ups. Thank you. We have the next question from the line of Vineet Malu from Birla Sun Life Mutual Fund. Please go ahead.
Hi, good evening. My question is related to aluminium. We've seen an impressive, ramp up in production. Just wanted to understand, in this environment of high cost inflation, what is our marginal cost? So, buying alumina from market and buying coal also from market for additional ton, what kind of marginal costs are we working with?
Yeah. So fundamentally, I think as we were saying that with the coal cost pressures sort of easing off with the better coal production and distribution in India. So if you go back, last year we were having margins in the vicinity of $400 per ton, but with our higher volumes and some of these cost pressures decreasing and our better and higher production of alumina at our own facilities, we can expect, margins depending upon how the cost develop in the range of about $600 to $700 per ton. So I think that is the scenario we are working in the immediate future.
No, sir. Let me can I just interrupt, please? Can I just interrupt, please? My question is regarding the marginal cost of production when you're buying alumina from outside.
Yeah, I think
not about current margins on integrated production, which I'm sure are very good.
Yeah, let me just supplement it. It's very simple, and we have reiterated in the past several times. We don't burn cash on a marginal basis. Very clear, very simple. Right, with this kind of aluminum prices, let's not forget that premium is also quite attractive. We have a huge domestic market to cater to, and the demand for the metal, it's a green metal, and demand for the metal is very robust. So there's no cash burn, if that's your question. The bigger picture here is about the 2.3 million tons, and how can you get to a $600, $800 margin profile, and it's a potential cash cow. It's a nice space to be in. That's really the big picture out here, and there's no cash burn if that's your focus question.
No, I understand. I'm sure you will not burn any cash. I just want to get a hang of the number because, as external observers, we are not able to get a sense of those numbers. That's all I'm trying to understand.
Yeah, I think it's very clear, it's positive. Let's move on to the next question.
So I don't have any other question. That is all I wanted to know. Thanks.
Sure.
Thank you.
Thank you. The next question is on the line of Pinakin Parekh from JP Morgan. Please go ahead.
Yeah, thank you. My first question is on aluminum. The aluminum cost of production has disappointed consistently on the upside through this year, and the 4Q guidance is $1,850 to $1,900 per ton. and this is based on improved materialization of coal linkages and elimination of the one-off impacts. Just trying to understand, in this current commodity price environment, is this the new normal base level cost of production in aluminum, if assuming alumina and coal and energy prices remain, or can this cost reduce from here?
Maybe we'll request Samir, any comments from your side, and we can supplement.
Yeah. No, I think your question is valid, but I would say that clearly these costs are not the new norm. I think the last quarter, why the costs have been high, not only for us, for everybody who has been using coal, was, as you are quite aware, of the logjam in railways as well as Coal India, which starts to ease off. So that's one structural part, because there are linkages which have been allotted to us, and those linkages will materialize. So that is point number A. And as you are saying rightly, let's leave the commodity prices as it is for the time being and say, okay, alumina remains where it is, carbon remains where it is. I think the big swing for us is our own refinery, which, as we said, has been now fully ramped up, and the last quarter exit, we will be producing at the full capacity of our own Landigarh refinery, and which is getting expanded further. So for at least, I cannot talk about other aluminium players, we can talk about Vedanta, that we have an opportunity of actually reducing that cost, and that cost will come down structurally, even if the commodity prices remain where they are.
Sure. Just to carry forward, in terms of the alumina refinery, what is, the expansion from wherever it is right now to 6 million tons? Would it take place only if there is bauxite security, and hence without that there won't be a refinery expansion? And if that does not take place, then how do we lower cost structurally in aluminum?
Samir?
Yeah. So I think, when we have decided to build and expand the refinery from 2 to 6, we have developed various scenarios of bauxite sourcing. And what I can share without divulging all what we have worked out, because some of this is competitive information and clearly we are not going to start divulging on, publicly, that we have various scenarios in which we will feed the refinery with various sources of bauxite. Some of them are existing in the country, some of them might be outside the country, some of them might be in different states, but either way we have different scenarios which have been stress tested, and we are quite confident that we will be able to feed. In first stage, you have to understand, to 4 million ton, 6 million ton is the second phase of the refinery. So, but 4 million ton is what we need today, because we produce 2 million tons of aluminium, which is why I am saying that, look, structurally we are quite confident that this will play out.
And when do we start work on the 2 to 4 million ton refinery expansion?
Arun, you might like to talk about, Mr. Kora, or I can say I think this has been considered by the board, and we are in the process of working out various approvals and the packages. So I think as soon as something is officially done, that will be announced publicly, and a public announcement shall be made. Arun, you might like to supplement?
I think that's well rounded up, and we are in the final stages of design, as Samir articulated. Once we are there, I think we will come and announce it.
Sure. Thank you very much.
Thank you. The next question is from the line of Sanjay Jain from Motilal Oswal Securities Limited. Please go ahead.
Hi. One question is on iron ore business. On the slide 24, you talked about that we've been granted additional allocation in Goa, but you're not quantified how much it is. And then you're saying that expect to produce high quality ore of 2 million ton. So if I look at we have 5.5 million ton capacity, but we've done 3 million ton sales in the 9 months. So that leaves us with 2.5 plus this enhanced production you're talking about. I don't know how much. So what is the total volume we should expect in the fourth quarter from iron ore?
Yeah. So I think and the positive thing is that we have started producing a better blend which sells well in the market. And so that process has been established. And now there are additional allocation by the state government this year to extent of 3 million tons. But Kishore, would you like to come and supplement?
Yes, thank you, Kauraji. And Mr. Sanjay, this entire 3 million tons which has been allocated in Goa will be produced from the ROM perspective in terms of production. And in terms of sale, we are expecting a sale of anywhere between 2.5 to 3 million tons in this quarter of both the good quality upgraded ore as well as the old 57, 58 low grade. Because you know the China market has undergone some strategic shift in terms of the steel margins. So that continues to be an opportunity that will happen post the winter session. So we are in that framework as far as Goa is concerned.
So, I mean, you 5.5 plus 3, that shouldn't that be 8.5? But
the 5.5 plus 3 would be the ROM production. Okay. The sale will have to carry some inventory of the low grade ores which may not be consumed by China immediately.
Okay.
Yeah.
And this, when you enhance this grade,
yes.
How much, like, you know, to the index, what discounts you are getting? Like,
see, the grades are enhanced not only in terms of Fe but also in terms of alumina, silica, and all the other impurities. So overall, the current discounts that operate in the market, as you know, earlier it was 45-46% of discounts used to go for the low grade, but currently we are at about 20s. So the discount is concerned.
You said 20?
Yeah.
To the index.
To the index.
But what is the grade like? I mean, if you 58 grade...
No, 58 grade with the improvement in alumina, VIU discounts are reduced. So it's all about the quality improvement overall.
Okay, so 20% with respect to adjusted 58.
Adjusted quality.
Thank you, Mr. Jain.
Yeah, thank you.
Yeah, thank you. The next question is from the line of Amit Dixit from Edelweiss. Please go ahead.
Thanks for the opportunity, sir, and congratulations for a good set of numbers. I have two questions. One is on copper. Since we are expanding smelting capacity from 400 KT to 800 KT, and TCRC margins, as we know, have been negotiated at a lower base. So are we thinking at some point to do backward integration in copper, as in to acquire some mines or, by some inorganic means?
Yeah. So, you see, this project has been conceived as a standalone copper smelter, basically. And we believe we are one of the most efficient copper smelters in the world. If you are, knowledgeable about our copper business, you will also know that we have some byproducts like phosphoric acid and other sort of waste to value stream additives, plus our gold slime refineries and stuff like that. So fundamentally, we are in a position to achieve net costs which are below zero, actually. So that is the potential this plant has. And with our long-term relationships which we have built over the last 20 years with the miners, we have a strong possibility to source good quality concentrates across the world. So we think with these attributes, we should be actually a fairly value-creative business as a standalone smelter.
Okay, sure. The second question is with respect to coal sourcing. Since there was a lot of disruption in, Coal India supplies and all, so can you just spell out that how much coal supplies was through linkage and through import, and how it is going to change in future, particularly FY19?
I can give you a broad answer. Maybe we'll ask Samir to supplement it. Fundamentally, the coal linkages were not getting realized because of lower production by the coal mines, and then the logistics bottlenecks because of railways. And in both these areas, there have been improvements, and we are not only realizing our linkages now, but we also plan to cover some backlogs of supplies which we had during this quarter and going forward. But Samir, you want to supplement this whole business?
Yeah. So let me give you a snapshot. Of course, we have Jharsuguda, which is catered by MCL, and Balco by SECL, but I'll give you on a sector basis. For example, Q1 linkage and linkage auction constituted almost 55% of our total coal requirement, which by Q3 dropped to 37% because of the reasons Mr. Kora just touched upon. And I'm sure you are aware of what's happening in the sector, because it's not only us, cement and everybody else. Now, what we are seeing in January, some improvement, not to the full extent of going back to what we needed, but there is a significant improvement. And what we believe is that going forward, especially in the next financial year, the situation should get better than what it existed in Q3. Now, how much and what exactly will it be? This is going to be looking into the crystal ball, but clearly the indications are that we are on the right track. I mean, we as a sector, and we see that the realizations are improving, even though February still continues to be a month of some struggle. So I would say, yes, I think our basic basket is comprised of 4 linkages, linkage auctions, which we get. Some auctions come and we participate. Then there are auctions which are happening. And last is the import. So for us, of course, we do an arbitrage and see clearly linkages and linkage auctions, and the backlog is the cheapest basket. And between auction and imports, we are doing an arbitrage all the time, that where is the cheapest coal, and we take and use that. As you would imagine, for us to give you what exactly the number will be taking a view on what the coal index will be on auction as well as import, which we cannot, of course, take. But as I said, 50% linkages, so that should, in the coming financial year, come back to normal.
Thank you, Mr. Dixit. I request you to join the question queue for any follow-ups. Thank you. We have the next question from the line of Saumil Mehta from BNP Paribas Mutual Fund. Please go ahead.
Yeah, thanks for the opportunity. So my first question is with respect to the capital allocation. While I understand the NCD investment as of now is small and the hurdle rates are pretty stringent for us, but how should we look at the overall investment in that area, and any further businesses where we find hurdle rates will be pretty attractive? And subsequent to that, the promoters earlier had made some comments about Anglo-American possibly getting merged with Hindustan Zinc. So as minority, how should we look at the overall corporate structure?
Yeah, thanks for the question. The line wasn't awfully clear, but I'll try answering. I think the latter part of your question, it has nothing to do with Vedanta. It's a personal investment by the chairman's trust, so we leave it at that. As regards the hurdle rates, I guess was the first part of your question. The audio was fluctuating. Sure. And the capital allocation. I think as we have been articulating, it's a very disciplined approach to evaluating a project, ensuring that these certain risks are built in, ensuring the right assumptions are taken in, ensuring that there's a plan B out there, and hence it's much higher. If you look at our WACC, in reality, it's probably between 30 and 15%, depending on what sort of alpha you attach to the number. And if you are comfortably 7, 8, 9% above all the time in terms of targeted IRR, which is also based on a fundamentally good set of numbers, then you can be rest assured that the company will add value to the investor by delivering a superior return. And that's exactly what we do. If you see, an example is Ganzberg, right? It's a project that we committed mid-teens, if you recollect, when we announced it. And the very fact that you saved project costs through some very innovative way of outsourcing the contracts that Deshni articulated in some of the earlier investor calls has led to a much higher IRR, not to add the zinc prices, of course, so the timing was also right. So that's how smart capital decisions work. Also, new ways of working, even in the oil projects that have been allocated, if you see all the big players are involved in it, and it's all more or less the costs are capped and they are outcome driven. Interesting ways the oil and gas team under Sudhir have been able to work out. So all this, I think, augurs well for better quality return than what you would typically see in traditional way of project evaluations. As far as acquisitions, it will always be absolutely case to case and very opportunistic, far and few, with so much brownfield opportunities in front of us. That's our focus.
No, so I mean, thanks for that. In terms of extending that further, is it fair to assume that any investment, be it in LCD or any other businesses, though IRRs would be attractive, will be in a phased manner so that the balance sheet deleveraging will not suffer? Is that a fair assumption?
So very clear, I think, since you mentioned LCD, is important to clarify. It's got nothing to do with Vedanta. Whatever LCD is very different. Whatever little glass is a glass business which feeds into the LCD industry. It's not the LCD industry per se. But you're absolutely right. It will always be balanced, and focus is brownfield. If you see what our CEO articulated, zinc 2 million ton. Just imagine 2 million ton. If we can really get there in the medium term, and we do expect zinc prices to stay firm in 18 months time frame. But even otherwise, we are the lowest cost producer in the world. With $2,000 margins, you can well imagine not to leave behind silver, which can well exceed 1,000 tons at that level. And again, the oil and gas projects, we are making them work at $40. So obviously at $70, which it is now, I'm sure one can imagine that the returns will be far superior than what you've been articulating. That's a good portfolio. And aluminum, again, once you're scaled up, the operating leverage is so high with the 2.3 million tons. So all this, temporary headwinds of coal, alumina, inflation, we spend 90% of our time worrying about it. But really, it's about 90% of the time pondering over the huge amount of operating leverage we have in aluminum. It's going to be a huge cash cow in future. You add all of this together, you have a very healthy cash flow and enough to invest in all our growth capex and manage all the capital allocation expectation. I really hope I was able to articulate it clearly for you.
Thank you. The next question is from the line of Anshuman Natri from Haitong Securities. Please go ahead.
Yeah, thank you for the opportunity and congratulations on performance. My question is regarding the bauxite mines which were recently won, and how do you see more auctions coming up for bauxite by Odisha government, and in terms of availability of bauxite domestically, how do you see it pan out, as well as own captive bauxite by Vedanta?
Yeah. So fundamentally, I mean, the primary source for us for bauxite, apart from the mines which we have already in Chhattisgarh, which currently also supply to this, will be the further mine concessions auctioned by the government. So that will become a primary source of bauxite. And as you know, I mean, we are very fortunate in India to have very high quality bauxite. Odisha itself sits on 1.3 billion tons of bauxite, very high quality, low silica bauxite. And this auction process should start soon. And in the meantime, if I mean the OMC has certain mines and they get into production, so we enter arrangement with them for offtake of some of those bauxites. So this will become our sources for feeding to our refinery of the domestic market.
Yes, the recent ones which you have won, how fast can these be ramped up?
All right. So, operator, any other questions?
Hello?
So that was the last question. I now have the conference with Mr. Ashwin
Operator,
Bajaj.
back to you.
Yes, Mr. Ashwin Bajaj, would you like to add any closing remarks?
We disconnected.
Sudhir, are you on? Hello?
Yes, I'm on.
There's some problem.
Thank you very much. Ladies and gentlemen, on behalf of Vedanta Ltd, that concludes this conference.